part of the American dream, I guess, is owning a home, having a nice Chevy or Ford or whatever it is, and it's sometimes not within the budget. It's risky when you don't have a plan. Like, how are you going to handle these periods that are going to happen at some point? 5 years from now, we're going to probably have a tough market.
Welcome back to episode 2 of the Plan to Rise Above podcast. And today's main topic is going to be the money myths that hold people back.
Let's try and debunk a couple that you might have heard on like TikTok or Instagram. Like high income, it equals wealth.
So generally, high income for us is 250 plus. As you get into your 40s, it's closer to that $500,000 range.
We got to know where each dollar is coming or going from each paycheck, and it's building wealth for you. It's working for you. It's not just sitting in a savings account earning low interest rates.
We see a lot of high earners. Their earnings high, but so are their expenses.
They have a very nice house, and they're like, hey, this is where all the rich people live in this subdivision. And those people had no money, and you sit down with them like, yeah, you got $175,000, but they have no money. They couldn't come up with $50 to put into a 529 plan. Welcome back to episode 2 of the Plan to Rise Above podcast. We're glad that you're here. We're excited to see you, and hopefully you're excited to see us. We have a fun day planned. We are going to go into some other topics, and today's main topic is going to be the money myths that hold people back. And I think there's a lot of them, but we're going to cover some of the ones that are top of mind for us that probably we see more often within our practice. So again, welcome everybody as we settle in, and we're gonna get moving. Where do we want to start? Ryan, you want to give us one to start with here?
Yeah, let's try and debunk a couple that you might have heard on like TikTok or Instagram. Like high income, it equals wealth. It might not. It depends how you are spending your paychecks. And we like to say every dollar needs a home. It depends on where you're putting that money after you get your paycheck, whether you're contributing to your 401k, you're building your emergency fund, your
vacation fund, everything.
Home fund.
Yep.
We got to know where each dollar is coming or going from each paycheck, and it's building wealth for you. It's working for you. It's not just sitting in a savings account earning low interest rates. And it's...
Yeah, you'll definitely, if you're a client with us, you'll hear us talk about the after-tax investment. So that'd be what we like to call is your bridge account. Your 401k is one that's top of mind for most people. Roth IRA, health savings account, vacation fund. It could be a wedding fund or maybe even a home down payment. So everyone's situation is unique on the goals that they're trying to reach. We just help them create a plan in action so that wealth has assignment, has a place to go, and it doesn't just get spent.
Yes, but let's say more specifically, right? If we have, what is high income? Is high income 100,000? Is high income 200,000? What would you say high income is?
Yeah, let me pull up the data here. So if we're looking at income by age, if you're under 35, the top 1% is 465,000. Top 5% is slightly over $250,000. So generally, high income for us is 250 plus. As you get into your 40s, it's closer to that $500,000 range. So to me, that's what I consider high income because you're in the top 5% of earners in this country.
And and that doesn't necessarily equal wealth, because what does somebody do who typically might make more money this year versus last year?
Spend it.
Yeah, we see
spend it, right? And there's a term for that, right? Which is
living paycheck to paycheck. So we see a lot of high earners. Their earnings high, but so are their expenses. They have nice homes. They have nice cars. They're doing huge renovations on their home, vacation home. That money, that lifestyle creep keeps going.
Yeah, and again, if their lifestyle creep keeps going, even though you have somebody that might be making $100,000, today, but then 5 years from now they're making $200,000. Their excess cash that we like to then say needs to land into their bridge, or that ends up every dollar needs a home. Well, those kind of fly away. They disappear because they end up spending it, and it goes into a backyard. It goes into their basement. It goes into wherever it goes, right? Because they just use it for something else, right?
Yeah.
So,
and we've seen it too. We've seen people who started a business early on. They weren't making much, but they weren't saving much, and now they've had more success. And all of a sudden, everything becomes a write-off. they're buying, new equipment because it's a write-off. But at the same side, you got to build, or at the same thing, you got to build up your side of the wealth. So yes, some of those things are a write-off. That's great to spend on, but you got to build up your net worth and your wealth first before doing that.
Yeah. One thing you will see, right? And again, we live in a pretty nice area of the country. We're in Lake County, Illinois, northern burbs. So we might have neighbors that are making 250 to 500,000, but the average person still is not achieving $1 million net worth, or they're not achieving a $2 million net worth, even though they have this high income, right? And they're spending a lot of money on housing. They're spending a lot of money on their cars. I'm going to give an example of even when I was, I don't have to go back to my rookie years, but I remember going into even very prominent subdivisions, golf course communities, trying to get people to save $50 for their college account for their 2 kids that might be 3 years old and 5 years old. And they've got a Mercedes in the driveway. They've got a BMW in the driveway. They have a very nice house, and they're like, hey, this is where all the rich people live in this subdivision. And those people had no money, and you sit down with them, like, yeah, you got $175,000, but they have no money. And they couldn't come up with $50 to put into a 529 plan. And then you go 2 miles across town to a 2,000 square foot house that has a kind of just, squared off house, nothing, no frills. The house might be 250,000 to 300,000, right? And then they've got $2 million, $3 million, $4 million in the bank, and yet they're living on $50,000 a year or whatever it is, that classic $1 million next door person, right? So high income does not always equal wealth, right? And what's the thing that we try to do with that? What do we try to coach them on?
Every dollar needs a home. So there's a plan for your income that's coming in. And just a sidebar, like I know growing up, everyone around me, whoever had the nice car and a nice home, I always just assumed they were rich, they were wealthy. And, now that we work with over 400 households, we see the people with the nice cars and nice homes, and a lot of times they're not what you think they are. So our goal is to help people, build up their net worth and not just their high income.
Mm-hmm.
Yeah.
Yeah. And then the flip side of that, right, is like low income does not always equal that you're poor, right? Because you can be that $1 million next door person who lives on $25,000 a year, right? And they're just saving $25,000, $50,000, $75,000, right? They've compressed their lifestyle to something pretty small, that they don't have the lifestyle creep. And now there's somebody who's 45 years old living on, again, very minimal expenses, and they're building out those assets, and they're trying to leave the quote unquote rat race early. So that comes back to that financial independent, retire early crowd, the FIRE crowd that's trying to, live on much less so they don't have to go to work every day, right?
Yeah, and I think some of those traits that we hope some of our viewers can take away is those people that are lower income or maybe average income, they live modestly, they invest consistently. They're saving 15, 20% of their income during good times, during bad times. They're always doing it. They play the long game. They're not trying to get rich overnight or find the next, crypto or whatever it might be. So they're letting their wealth compound and grow over time. And they're also raising good families and independent kids. They do support their kids, but as they get older, they raise kids that are self-sufficient. They're not sending them thousands of dollars every month. They're not paying their down payment for their home. So they transition those values from themselves to their kids. So I think those are some of the traits. And I'm sure, Phil, with your years' experience and Ryan being here now, you've seen other ones that clients have been doing to help better themselves.
Mm-hmm.
Yeah.
Yeah. And then I would add there's another demographic in there too, right, which is retirees generally. And I think a lot of people, especially younger people, tend to dismiss some of the retiree crowd, like they have nothing to learn from them. But there's a lot of the people that might be 65, 70 years old, right? They've lived on a budget their entire lives. And when they finally, are retired and they're not working, they end up having, they're still living the same lifestyle they've always lived. So they might have Social Security only and very little income, but they've got $2 or $3 million sitting in their investment accounts with us, and they could go to Florida tomorrow if they want to. They can go to Alaska if they want to. They can do whatever they feel like doing, right? But they still just choose not to because they live modesty, and they're like, this is the way I've always lived. I don't really need a lot. I like hanging out in my backyard and doing my garden and eating healthy and going to work out and play pickleball or whatever it is. I don't need to spend a lot of money, right? So there's also that crowd that's very content with what's going on, and then you have kind of this dynamic of again, the high income earners doesn't always equal wealth, because you have young people that are like, well, I got to kill it. I got to make 100,000. I got to make 200,000, but then they spend every penny, right? So I don't. I just say there's a disconnect. So that's why it's a myth, right? That they don't always. It doesn't always equal wealth, so to speak. So
Yeah, and going into the next topic, some of the things that hold people back is debt. So one of the things we want to talk about is not all debt is bad, but there is some debt that can really kill you. And some of that debt would be credit card debt. That is something that you want to avoid at all costs, because those interest rates are 20% plus at some times. And then also PMI, that's another one. So those are types of debt that we would consider bad debt that can hold you back. But on the flip side, there's forms of good debt where it's okay to take on. And I don't know if Ryan, if you want to touch on some of the types of good debt that you would be okay with having a client.
Like mortgages, there's perfectly okay. Nobody's putting down 100% down payment on a home, so it's very reasonable to put it down a smaller down payment or a reasonable one. You don't want to break the bank and go through your entire emergency fund putting down 100% or 50% down payment. So that mortgage piece is actually very helpful for some people starting out, just buying their first home, learning the ways of all the financials. Like another myth that we wanted to touch on is buying is always better than renting. And I feel like George has a pretty good understanding on it because he rented for 2 or 3 years, I think.
Yeah, I was 3 years in Chicago, and you just always got to run the numbers, because when you're renting, the max you're going to pay is that rent payment. When you have a mortgage, that's the minimum you're going to pay. If you have a mortgage, you're going to have that. You're going to have property taxes, insurance, HOAs, maintenance on the property. So it adds up quick. And I felt like even myself, I was paying a high rent number in the city. And now today my mortgage is cheaper. But if you add in all those other expenses, it's definitely more than what I was paying in the city. But granted, I'm having more space and I have a family there, so it's good. But a lot of people don't consider those phantom costs that I was just talking about. Yeah. And then I want to touch one more thing on the mortgages. So mortgages are great, but where they could be bad is sometimes people overextend themselves. I know when I went for their pre-approval process, they approved me for like $1 million home, and I have no business buying $1 million home. Maybe one day I'll be there, but right now, today I'm not. But in the bank's mind, they're like, yeah, this guy's fine. He could buy $1 million home. And so one of those things, just because they can allow it doesn't mean you should. So, meet with your advisor, see what fits within your budget, add in those hidden costs before you get locked into a 30-year mortgage. I think that's something, very important for people looking at homes.
Yeah, and you got to remember, right? Those bankers are getting paid a commission on that amount of money that they're lending out, right? So if they can get you to take a bigger mortgage, well, that's better for the bank, better for their bottom line. But it doesn't necessarily mean it's better for you by any means. So
yeah, you don't want to feel stretched because, your mortgage has got to get paid. Otherwise, you foreclose on your home. So you got to make sure it fits within your budget. And we've talked about, I think before, the 28% rule. So if you take your gross income, no more than 28% should be go towards housing. So that's a rule of thumb. It's not, it doesn't have to be exact, but that's a good range. It could give you an idea of how much you should be spending on your mortgage.
Why else would somebody choose to rent versus own, I suppose, right? Is there,
Yeah, I would say it's the flexibility. Like if you, maybe you're still looking at different jobs. You don't know where you're going to end up, or like you don't know. Maybe you met a girlfriend. You don't know if you're going to be in a different city in a few years. It's not having, the minute you're locked in the property, that's a lot of weight you got to carry with you, a lot of stuff that could derail your plan. And so I would say flexibility. Flexibility is the main one, I would say.
Okay. And then, and like right now, Ryan, like all your friends, you're younger, right? So, any of your friends own a house just yet?
No,
Anybody have any plans to buy a house anytime soon?
not with these housing prices.
There's no shame in not owning a house at your age right now. People are comfortable just renting.
Yeah, definitely, because we don't know where we'll be in 5 to 10 years. We want that flexibility. You get a new job in another city, you can't. It's harder to pick up a owned home than it is a rental apartment. And rentals are great. It's easy. It's flexible. You don't have that HOA. You don't have property taxes. You don't have to maintain the prop. You do, but not the outside as well. But it's more freedom you get, and it's better for younger families and job movers or people that move across the country. But there's obviously better ways to go about it.
Yeah, and I think a lot of people they always say, well, real estate always goes up in value. In the past 5 years, it definitely has. Real estate has done very well, but that's not always the case. And even if it does go up in value, if it's short term, you're going to have closing cost. That's going to take 5 to 7% off the price that you sell. So maybe it did go 5% in a year, but you're going to lose on the closing cost regardless. So those are some of the factors you got to keep in mind if you are looking to buy, especially if it's short term, because you want to make sure it's long enough where you could recoup some of those closing costs.
All right, perfect. And then and then we didn't go too deep into myth 3, which was all debt is bad is necessarily, right? But the main thing we want to kind of stress is it's if you're going to take on a mortgage at some point, that's not necessarily bad debt. It is forced savings. It is you trying to build equity, and over time you are, because if housing does appreciate over time, which it generally does, it may not over the 3 to 5 year period, but if it can over 10 or 20 years, you are building equity in that position, and you are saving every month. Which if you didn't have a mortgage, you might have piss that money away. So I think there's, just building that habit of having a mortgage is actually probably pretty positive for most people, right? And so it wouldn't be bad. A mortgage doesn't mean it's bad debt, because it is forced savings. And
another type of debt that I want to hear your opinion on is, what about a new business owner? Like, to you, would that be good debt, bad debt? If they're taking money out from the self, is there a rule of thumb or kind of a gauge you say, like, hey, this is an okay amount to invest in your business? Where are you taking it from? Have you seen any of that with some of your clients?
Of course, but yeah, that's a tough one, because every situation is different, right? But I think for those, you have to go into first, is there an emergency fund piece? Is there an emergency fund in play? Do you have any backup? You may not, right? But ideally, you would have at least 3 to 6 months of expenses behind you before going down that route. But that's not always the case. I think generally speaking, and again, this is a dangerous answer for me, because I have 2 employees that we're talking about trying to be business owners, maybe, right? But generally speaking, right, and this comes back to we'll repeat this a lot, right? There's 3 ways to separate yourselves from the masses, and that is assets, which is stock market, even the bond market, and real estate, and owning a business are the 3 things, right? So yeah, I mean, I think ultimately you want to be a business owner in some way, shape, or form, and at some point you have to make that leap. So to take on some debt to do it obviously makes some sense, but it's a dangerous proposition. So you have to look behind you first, I think, and just go, okay, is there emergency fund in place? What is my likelihood of actually having some revenue or earnings out of the gate? What are my expenses behind the scenes, right? Am I single? Is my flexibility massive? Or do I have 3 kids and a wife in a $1 million house? Right? I mean, where is everybody in their journey of life, so to speak? And, if you're more nimble, that definitely helps, and you can afford to take more risk. If you were an employee for 25 years, well, then it's probably going to be a little harder, and you probably need to have a bigger emergency fund behind you. So I don't know if I can totally answer that question, right, without knowing the situation, because that's a tougher one. But at the end of the day, I do believe in today's world, I hate saying it because I have employees and I want you to stay employees. But at the same time, you need to, I do feel like you have to at least have some ability to have ownership And again, in the sales world, you can kind of backdoor that without having to be an owner. But I do feel like, yeah, assets, so stock market, real estate, or owning a business, I do believe is a game changer, and that's where everybody should be striving for. But at the same time, not everybody is comfortable with the risk that comes with that, right?
Yeah,
So,
and I would think too, for some of our viewers, if that's something you're thinking about doing, you want to do your best to keep your fixed expenses low. Everyone has their variable expenses that they can take out, if you need to. So get a bottom line dollar of like, this is a minimum that I need each month to live off. Keeping that low is a big thing. And I think, Phil, even when you opened the doors at PMG, you went through this exact scenario. You had, was it 2 kids at the time?
2, yep.
2, and then you were preparing to launch, go independent, and at first revenue was probably low until all your clients came on board and you built it back up. Did you take any sort of loan, or did you just have emergency fund?
I did have I did have a small transition loan when we did it, yes. Yeah,
Okay.
and it was something that was paid back over, I want to say it was maybe a year and a half, like 18 months that had to be paid back pretty quickly. But yeah, we did have a transition loan, and at that point in time, yes, that did make sense to take. I also did have a pretty high conviction. If you know me, you know, people who know me, like, I've always had high conviction on things that we do. But that is something that people say failure is not an option. Obviously, failure is technically always on the table, but it's something that we didn't think was going to happen, and obviously it did not. But yeah, you have to have that strong conviction, and I felt like we were going to be fine, and we took that loan, and that loan, I think maybe that specifically, I think it was paying something like 8% at the time, and back in 2007. So it wasn't horrible by any means, but it wasn't cheap either, right? So it was still something to consider, and but that's something that we definitely took a loan at that point, and I would say that was definitely money well spent at that point.
Yeah, and I'm sure it was a tough adjustment for your family too. I know your wife's a teacher, and just adjusting from the loss of income at first. Like, did you guys have to change your lifestyle in any way?
Oh, of course. Yeah. I mean, we lived a little bit more thin at that point in time, but that's something that we were also used to, just from our upbringing. So it wasn't as dramatic. And then again, I opened the business specifically, I was 32. So so I wasn't that old, and we also weren't probably that deep into where our lifestyle is today. So we were able to do that flexibility because we were of the age that we were, so that's part of it too.
Yeah, Phil, that was a really good point on you making a real life decision and investing in yourself. But let's bring it to myth number 4. Investing is too risky. We believe that investing can be risky in the short time because markets are very volatile, but it's very rewarding long term. You just got to stick with the market. The chart of odds of success in the market is way higher than you keeping that money in a savings account, because inflation, I would say keeping that money in a savings account is more risky than investing it in the market, because inflation over time will erode that dollar sign or that dollar figure in your savings account. And investing, the market keeps up with inflation over time. So keeping it in a savings account, I would say, is more risky than investing in the market. And
to touch on Ryan's point too, I was reading a blog post the other night, and it was talking about market returns the last 30 years. So going back to 1995, we had the dot-com bubble, financial crisis, 9/11, Iraq war. This year we had Liberation Day. We've had millions of different things, high inflation. And during that period, the market returned over 10% a year. So long term, there's going to be hiccups, where it is risky, right? There's COVID, where the market sells off. But if you stick with it, to Ryan's point, over time, generally you have been rewarded, staying invested and enduring some of those ups and downs.
Yep.
Yeah, and I feel like Phil has gone through, he opened the door, or he's been in the business for 35 years?
28.
28 years.
He's not that old.
Yeah. Sorry about that. But he's lived through it all, and he can kind of explain, there's been times where the market's down, but over the long period, it's gone up, it's done well, it's bounced back almost every time. Long term, or it might have taken a little longer back in the day, but now it's bouncing back pretty quickly.
Yeah. And I would say when Phil started, he had hair. And now after all those events, he doesn't have hair. So it takes a toll. It's a little stressful during times. But there's changes throughout of it.
I don't even know how to say that. What the hell? That's okay. That's all right. When we get off this camera, I'm kicking some ass. But it's all right. We're good.
I know I'm getting it back with the orange car or something else.
Yeah, it's all
right.
good. But no, I mean, when we started in 1997, we had the tech bubble. The market was amazing. At the end of 1999, the NASDAQ actually hit a 10-year rolling period where it was returning almost 20% for the entire 90s, which is unheard of. And actually, I would argue that the flip side of that was more the case where people were like, well, why do I even need you as an advisor? Because I can just go make 20% in the market, buying tech stocks. And then, of course, the rug got pulled out from everybody. And, the NASDAQ went down like 60, 70%. The S&P goes down like 40% through, essentially through 2000 to 2002. But then, it does rebuild back up. And then we have the great financial crisis in 2008 and 2009. Builds back up, and as you go through all these things that you mentioned, now we're back to all-time highs. And, so you got to stay with it. And there's going to be some bad times and whatnot. But I look at, the phrase investing is too risky. I view it the opposite, which is more so like doing anything else I think is too risky. And investing is actually the right thing to do and almost like the mandatory thing that you should do, right? That everybody should do. And like when we look at when we look at long-term financial plans and the cash flow projections, so to speak, we're not really worried about somebody running out of money today, right? We're not worried about them running out of money in 5 years when we're building a plan. It's always the longevity piece, right? So it's always like, where are you going to be 20 years from now? And if you were just making 4% in a money market account forever or CDs, that person eventually inflation catches you. And so to me, like the real risk is not the stock market. The real risk is inflation and running out of money because of just the cost of living. So to me, like I'm just looking at the longevity piece. Like, so when people say the myth of investing is too risky, like, yeah, it has its moments. It has its moments where it's not good, but where it can go down and it kind of sucks. But to me, like 20 years out, eventually the cost of eggs is double or triple. Houses have gone up, right? Crazy prices. We can start getting into examples of, when I graduated from high school, like a really good car was like $20,000. Right. And like even a Mercedes, I think when I graduated college was like $35,000. And now a really nice Mercedes is like over $100,000. Right. Pickup trucks were $20,000. What's a GMC fully loaded truck now?
And now, we see that. I've seen that with people too. They buy, their income's lower, but they're financing a $70,000 truck and they convince themselves that they need it. And really, the only thing they're putting in their truck bed is some golf clubs. Like they don't need to be buying something that expensive. It's like part of the American dream, I guess, is owning a home, having a nice Chevy or Ford or whatever it is. And it's sometimes not within the budget. But back to the point of investing is too risky. I think it's risky when you don't have a plan. Like, how are you going to handle these periods that are going to happen at some point? Between now and 5 years from now, we're going to probably have a tough market. And it's like, what is your plan? How is your portfolio positioned before we have some of those down markets? When it does hit, are you buying? Are you selling? Are you going to average into the market? That's always been a very successful strategy for some clients is like, my account's down, but now I'm also buying at lower prices. So it's easier to navigate some of those tough environments. So I think you plan ahead, it makes investing a lot easier over the long term.
So what you're saying is if investing is too risky, one of the ways that you can solve for that is by regular contributions.
Yeah. So, I do it myself personally. Like I try to add every 2 weeks, I'm buying something, or every month I'm automating it. So the market could be down tomorrow. And it's not something I'm thinking about. I'm not thinking about, hey, I'm buying today because the market did X, Y, Z. It's just every month it's consistent over time. Hopefully a decade from now I'm rewarded. But that's like my personal plan, going through different market environments.
Mm-hmm. Yeah. And then what do most people have through their employer? What's the name of that plan called?
401k.
401k. Very good. Good job, young Padawan. Yeah, good job. So then, and then obviously you want to be contributing to that plan because you're taking advantage of the dips and the good times and the bad times, and you're averaging out that cost. So good job. Excellent. And then anything else you want to add on that topic?
Yeah, and I think just starting out too, it doesn't have to be thousands of dollars a month. It could be $20, $50 a month. It's just building that habit is a more important thing. It's like getting consistent, saying, hey, it might only be 50 months to start, but as you get better, as your income grows, that dollar amount will grow. So like just learning good habits early on is a huge thing to having success, building wealth.
Yeah, and one of my friends, so I'm 24, and he just started with $200 a month to a Roth IRA, and he's probably already ahead of half our friend group, half of our age group, because he's starting early. He's going to get some tax-free growth, and he's going to have this huge tax-free bucket to pull from when he's retired, and he's just way ahead of the group already.
Yeah, that's phenomenal. That's good. That's good.
Mm-hmm.
Yeah. We got to get him in here. But the other...
He is a client. He is a client.
Oh, okay. Okay. Well, shh. Sorry. The other thing I want to add, I don't want to beat this up too much, but... just like the three of us are also we were finance majors in college, right? And not everybody has a business degree. Not everybody went to school to study finance. But one of the basic things that I feel like finance majors get hammered on in school is the discussion of inflation, right? And so to me, like when we talk about investing is too risky, that's why I say like it's easy for us to be like, oh, inflation, cost of living, whatever. But again, we went to school for that. We paid thousands of dollars for school, and that's what they like to hammer on. And I just feel like to me, I look at it really is kind of simple. I look at it like investing is not that it's too risky. It's really like it is the best solution. So just do it. Essentially, like you got to get into it because the net real return after inflation at the bank is usually close to zero. The net real return on most things is near zero. And the gap between the stock market is a positive 4 to 5% over inflation. The net on real estate is 4 to 5% over inflation. The net on other assets in owning a business is better than that, right? Whereas the safe option, where it may appear safe at first glance, it really is not safe at all. And that's the piece that, and at least in again, you need it for some cash flow here and there, but at the end of the day, you want to get it somewhere else.
Yeah, and inflation's never going away. The Fed, even themselves, they target 2% inflation per year. So that's their goal, to have some inflation. So, over 30 years, you can just assume the cost of your iPad is going to double, your cost of your TV is going to double, because that's their goal long term.
Yep. Okay. Very good. So where are we going next?
Myth number 5 is estate planning is only for the wealthy. We think it's really for everybody. Everybody needs to be planning for their future generations and how they're going to handle your wealth or what you built, your business, your bank account. You got to have a plan in place just in case you get hit by that car or your boat goes down. You got to have these plans in place so that they have instructions for those future generations on how to deal with your money and what your goals were for your future generations. You don't want to be left up to the state to decide for you. You want to have a plan in place.
Yeah, like Ryan said, you don't want your assets to get caught up in probate, and then your next generation is waiting 6 months. They got to pay a lawyer. They got to pay court fees, all of that. Like in those tough times, they want access to that money quick, and they want to be able to spend it on what they need. So there's small things. I know, like even here, Ryan, we do the TOD forms, and just having that on every account, making sure it's set up and having your beneficiaries up to date. And even now we're working with wealth.com to help people create their own trust and make sure that is set up. Their homes are in the trust, their accounts are in the trust, and how it's distributed is pre-written, and they know exactly where their funds are going if something should happen. Yeah, and so with estate planning, it could be something as simple as a TOD form, transfer on death, meaning if you pass, where are those assets going to? If you don't have that set up, then it's up to the court to decide, and that could take 6 months to a year, and you got to pay all those fees. So something that takes 5 minutes, not even to set up, could save you a headache or save you from a headache down the line.
Yeah, no, I mean, that's a great point. A lot of times we see, like, from our side, we're always adding these TOD, transfer on death forms, stating essentially for a non-retirement account we're adding a beneficiary to a form that doesn't always have a beneficiary attached to it, right? But a lot of things that slip through the cracks will be people's bank accounts. And so if you think of your checkbook, that might just say your name in the top left corner with your address. It doesn't say anything behind that, right? So you might want to go to the bank and be like, hey, what happens to this account in the event that I die, right? And now, again, if you have a joint account with a spouse, then it should have in the top left corner both of your names there. But the same question applies. Like, go to the bank and be like, hey, what do we want to do in case we die? They have a little one-page form that'll it'll slap the kids on there. Or if it's just if you're single, it'll slap whoever you want to, go on there, a brother, a sister, a parent, whoever it may be. And it's not just the person on checkbook, because, so I see that one that falls through the cracks way too much. And then somebody literally has to go to court and get an attorney and take about 4 to 6 months just to get a $3,000, $5,000, $10,000 account, and at least just to close that account. Otherwise, just let it go to the state and walk away from it. So, so again, it's one form. So that's the payable on death at the bank, and then it's a transfer on death with any brokerage house. Anybody who has accounts elsewhere, obviously.
And I think for families that are very successful in this area, they're having these conversations early on. At the dinner table, they're talking about it. They're coming in with their kids to the meetings. We're looking at the net worth statements, where their assets are located, and double checking those beneficiaries. So, it's just good to have the open dialogue with anyone that you see inheriting any of your money. It just makes the transition a lot easier. They know us, they know who's calling if something does happen. So I would just say make sure to have those conversations early on.
Mm-hmm. Yeah, one thing I wanted to touch on is the powers of attorney forms. Those are actually very helpful because even once you turn 18, your parents really don't have any say in your health care or your financials because there was nothing in place for them to even know or the state to know. So having all those forms, even like for myself, a power of attorney for financials and health care is actually very helpful for me because I have kind of a peace of mind that I know somebody I trust is going to be able to do it and take care of it the way they probably thought I would want it to be done.
Mm-hmm. Yeah, and let's say your parents ever had a health condition and you need to help out, but you need access to their funds, you're going to need those different forms on file to be able to go ahead and pull from their accounts or make a healthcare decision for them on their behalf. And if, like we talked about before, if you're talking about it beforehand, what they would want to do, it makes it a lot easier.
Anything else we want to add? Any other myths that we can think of right now that we want to go on?
Assets don't always go up right away. So I think that's a myth I'll run into with some people. They're like, hey, they're coming in for their first meeting, like, what's my return going to be next year or over the next year? And it's not always just straight up right away. There's going to be periods where the market's down. Like 2018, we had a down year, and then 2019, the market was up. So the market is rarely average. It's rarely 8 to 10% your returns. It's going to bounce around. You have years of 20, years of 2, 0%, whatever it might be. So a myth that it's going to be consistent, that's not true.
One I personally dealt with, people think tax refunds are free money from the government. They're not.
That's a good one, actually.
Yeah.
You're basically giving free money to the government on a 0% interest loan. While you could be using that money to max out your 401k, build that emergency fund, vacation fund. You got to make sure you're not giving the government your money to just sit there. You got to be putting it to work every day.
Yeah, that's a really good point, Ryan. And I see it a lot with couples where one spouse is over withholding and another spouse is under withholding. So look at your tax return, look at your effective tax rate, and whatever that is, both spouses should be withholding the same amount, even if they earn different incomes. Since you file jointly, you got to make sure that effective tax rate is the same for both. All right, to wrap it up, if you believe any of these myths, don't beat yourself up. That's what we're here. We're here to help you. We've seen a lot of households make these same mistakes and how we help them fix them. So we're always learning. We're always getting better, 1% better each day as we talk about. If you got any questions on your specific situation and how you can avoid some of these pitfalls, go ahead, email us, call us, like us on LinkedIn, like us on YouTube, and go ahead and follow along, and we'd be happy to help you.
Very good. Yeah, so we'll see you again next month, everybody. And don't forget, plan to rise above.